market, absolutely flat, with a bit of a negative bias on the Nifty, down about 30-odd points. The Nifty Bank is the one that I'm looking at because, here is where the pressure is really seeping in. So down about 128 points at the opening itself. And that's dragging the overall index closer to that 22,000 mark. Now, just to take it straight to a couple of individual stocks, right? The banks are in focus. HDFC Bank, the company said that the focus will now be on profitability. They will not chase high-cost deposits. But the stock is absolutely flat, not doing anything at all. Kotak Bank actually is the one that could be in the green. Yes, it is 1% higher after the management changes that have occurred, where KVS Manian will now become the joint managing director again. So Kotak Mahindra Bank in focus. Coal India was the big mover yesterday on the downside. Some more traction there on the downside this morning, down about 2%. The fall in e-auction premiums is what has spooked the street. There are a lot of brokerage downgrades that have come in as well this morning. So Coal India in focus. Next up, we have Godrej Consumers. They will divest their entire stake in the Mauritius-based arm Godrej East Africa Holding. It's for a small sum of $3.5 million, but the street likes it. It's up almost 1.5% as we speak. Apart from that, you have NBCC. The company has got 3 work orders worth 369 crores, and the street likes that, up almost about 2%. Torrent Power is looking to invest 2,500 crores in 4 projects in Uttar Pradesh. The street likes that as well, 3% higher now on Torrent Power. Deepak Fertilizers, look at that move, 9% higher on Deepak Fertilizers this morning. There's a 15-year contract with Equinor for LNG that Deepak Fertilizers has signed, and the street is giving it a 2 thumbs up. Apart from that, you have Biocon, down 3%. Jefferies has downgraded Biocon to an underperform from a neutral. They have a target price of 250, which is well below the current market price. In fact, since we're talking about pharma, let's take it straight to Glenmark Pharma as well. HSBC has upgraded Glenmark Pharma to a buy from a hold, and they've raised their target price to 1,100, which is well above the current market price. The management was also quite optimistic when we spoke to them a couple of days ago. There's about 25% equity that has changed hands on Whirlpool, so that stock is down about 2.5%. It's largely about stock-specific action. If you look at the headline index, is very, very quiet, just consolidating around that 22,000 mark. And the advance decline ratio right now is well in favor of the advances. So not a bad opening, flat with a bit of a negative bias, but all the action is in the broader markets. Back to you.
Well, sectorally, auto and IT are the 2 pockets where you are seeing weakness. So the Nifty Auto Index is down close to about 0.5%, as Eicher Motors, Bajaj Auto and M&M. All 3 of them are staring at a cut of 1 to 1.5%. And IT too is on the back foot, with TCS and Infosys leading the way with a cut of close to about 1.5%. So sectorally, that's the drag today. And the gains are led by media and realty. Media, and particularly Z Entertainment, the stock is up 6.5%. But the Nifty Realty Index is up nearly 1%. A couple of the other notable movers, where there is no news, but you are seeing a lot of price and volume action. MRPL is a laggard, 3.5% gone on that. SJVN is under pressure. Rain Industries is down after the recent up move that we had. It's up 24% this month, but today it's a bit on the back foot. On the gaining side, you've got Zaggle Prepaid, 9% and very large volume. Tourism Finance, where there was a block deal early in the morning. That stock is also up and about in trade. PTM has gained nearly 5%. And a couple of the other Z Group stocks like Z Media too, seeing some buying.
Absolutely. And so, in terms of advanced decline, it's a pretty good start, right? Although the market on the index is down about 50 points, but that is the Nifty, right? But in the broader market, as you guys have been pointing out, there is a lot happening on the upside. So I think the last one mentioned was Zaggle with a 10% pop. So that's a big one. But look at Jindal SAW, which is up about 6%. Large volumes, 556 on Jindal SAW. Minda Corp is another one, which was, of course, there's news there. 3% higher, 437, 438. It was a mover yesterday as well. Look at EID Parry. It's got a bunch of businesses. Sugar is, of course, one of them. And it's been an underperformer, laggard really, but it's starting to make a move. 7%, 7.25% move on EID Parry now. Azad Engineering is up 5%. Shilpa Medicare, we were talking about this with Amnish earlier, 5% gain there, 434 on that name. Delta Corp ended 4% higher yesterday. And I think there were some comments from Rajiv Chandrasekhar yesterday at a conference here in Mumbai where he said, well, the government essentially wants to promote wants regulations so as to make sure that the industry sort of grows properly. Not sure if that's the trigger here, but Delta is another one which is up 3. There is Sequent Scientific, which is up about 3%. Tourism Finance Corporation, TFCIL, there was a large percentage block deal which happened in the morning. That is up about 5%. I think that's the daily limit for TFCI, Tourism Finance. TV18 Broadcast starts about 4% higher. And I can go down the list, but then volumes are a little lower. On the downside, there is of course Whirlpool, which we mentioned. Coal India, which ended down 4.5%, is down another 1.5% this morning. Federal Bank is a top volume-led loser with a 5% cut today. There is Rain Industries. It's down about 2% right now. Biocon is coming up. We just put out the brokerage call with, I think it's a downgrade on Biocon, 3% lower on Biocon. There is Patanjali, which is down 4%. Eicher Motors, which is down 2%. HAL, which is down about 1.5% as well. So that's the sort of up and down. But market breadth overall, numerically, of course, is vastly in favor of what is doing well and what is higher. Vineet Samre is with us, head of equities, DSP Mutual Fund. Vineet, great to have you with us here. Appreciate your time here on CNBC-TV18 as always. I mean, just a word on HDFC Bank, if we can begin this conversation with Vineet, because the analyst day happened yesterday. There was some. I'm not sure if you had a person there, and what is the feedback that you got. But what really is your sense? Because it's also important and pertinent because you got the rest of the market where valuations are running generally higher or much higher than historical valuations, and you got this large group which is banking, and within that HDFC Bank where valuations are reasonable, and money is coming into the market. You've got to put money to work. So this question then becomes important. Go on.
So good morning, Prashant. And there's some limitation to the extent to which how much I can talk about the companies which we may be transacting or we also have in the portfolios. But broadly, if you look at our portfolios, we have been in general, I think positive on the private sector bank, and within that, HDFC Bank is one of our holdings in the portfolio. Now, overall, I think from the time the merger took place, I think the expectations around the way in which the bank will sort of start showing growth, and also the consolidation timelines of the consolidation, the benefit which the banks will derive. I think those have got a bit sort of pushed out to maybe beyond the in general expectation. But what we believe is that we feel that, like you mentioned, overall, if you look at the markets, I think the market is has pushed up the valuations for most segments. Banking as a pack here, we are trading at reasonable valuations, including the bank under consideration today. Maybe the recovery process may take time, but this is a good time to accumulate these high quality franchisees and hold them on. I think the way to create wealth over a long period of time is to sort of look at high ROE businesses which have sustainable growth prospects in the future. And only point is, I think the biggest arbitrage one has is the time arbitrage. Information arbitrage is something which people have lost out. So I think from that perspective, it makes sense to be part of this large franchisee is what I believe.
By the way, many stocks hitting fresh highs despite the lackluster opening. Indian Hotels is at a fresh high this morning, and it's been one of the strongest stocks this year. It's up 25% already this year, and it's at a fresh 52-week high at 546. Jefferies put out a note yesterday where they said that the double-digit revenue growth is something that can continue in FY25 for Indian Hotels. And given the kind of robust wedding season that we've seen this time around, the trends continue to be positive. Vineet, I wanted your thoughts on some of these spaces, right? Whether it is aviation, hotels, hospitality in general, consumption, discretionary spending, all of these spaces are picking up quite a bit. You think the run is done here? If someone's missed this bus, is there more to go?
Yeah, so unfortunately, we have missed out on participating in some of these businesses, like you mentioned, the hotels, aviations. Because in general, when we looked at their long-term history, we figured out that these businesses they don't generate high ROEs, and they are very cyclical in nature, and it's very difficult to then take a slightly longer-term view on some of these businesses. And today, the cycles for them are very, very positive. But what we have sort of focused on, I think, are some of these, retail malls which have done well for us. The consumption trend has been good as far as the premium and the urban consumption trends are concerned. We have also looked at some of these QSRs, which in the past has really done well, but currently they are undergoing some bit of this slow demand momentum, and we believe that the opportunity size is huge. We are currently in terms of our overall exposure as from within the food industry, QSR is a very small proportion, and we believe that as the urbanization grows, as income grows, the consumption trend should pick up. So I think over the next few quarters, maybe, and I've been saying this for a while the consumption trend broadly looks slow, but this is also a good time to gradually build some of these discretionary names, is what I feel. But only caveat being that we would like to focus more on businesses which structurally are able to produce decent ROEs over a long period of time.
Okay. So you think QSRs are turning the corner, like Jubilant FoodWorks, Devyani, Sapphire, Restaurant Brands, Asia. What about the other portion of discretionary? Names like a V-Mart Retail. We know Titan is doing well, Trent is doing very well. But some of the other pockets like Vedant Fashion, Nykaa, here you have seen the impact of slowdown in discretionary spending. What about that aspect of the consumer? Are you bullish on it?
Yeah, so just to clarify, when I spoke about the QSR, I was not hinting at, they're turning around. I'm saying that they're still in the midst of a slowdown phase, but that's also good time because the stocks, otherwise you don't get these stocks at maybe, decent valuation. So I'm saying that over a period, as these companies go through a bit of a slowdown phase, each of these companies and the ones which you mentioned also, these are, high quality franchises. And as these companies are facing challenging times, maybe at certain point in time, every company will find that a lot of these are getting discounted more than required in terms of the valuations when we look at the long-term averages. And at a point when these becomes attractive enough, it will be good to start accumulating those in the portfolios. Is the strategy which we are trying to deploy.
At a time when most global economies are struggling, right? We just heard about Japan and UK entering into a recession. China's property market is pretty much in a bubble. India is standing tall, especially with the growth projections. Now, I understand that it's not as simplistic as we expect it to be. Money is not going to directly move into a market like India. But given that we have this kind of a situation, do you think India has the upper hand even in 2024? And could that be one of the reasons why this uptrend could continue?
So, see, first of all, let me admit that as far as our country is concerned, we will have relatively much better growth metrics as compared to some of the global peers. But at the same time, let me also mention that when we look at the long-term growth trends for India, India does well. It does exceedingly well when the global, countries are also doing well. So it only adds up to the momentum. And if we have large economies actually struggling, or you have some of these developed economies go through a slowdown phase, I would want to say that India would not remain unaffected. We will also see some bit of the impact of slowdown. And if we observe the third quarter results, which just have got announced, a lot of the companies which are export-facing, maybe IT, some of the bearing companies which have exposure to their global parents, they are selling their products there. We have seen considerable amount of slowness in the business, and which is where I believe that some amount of impact we will also carry through. Just that relatively we should be better off. Since I've touched upon the Q3 result, let me also mention that. Let me just also mention that if we look at the last 3 quarters trend, the top line has been decelerating, and we've come down to a single-digit growth number. While the earnings momentum is strong, the benefit of the margin tailwind has flowed through, but that also will come in the base now. And hence, to me, I think it is very important that as we go towards the next 2 or 3 quarters, the sales momentum has to recover. Otherwise, we will see slowdown in the earnings as well. So I think from that perspective, next 2-3 quarters remain important, where the valuations are at highs and maybe the earnings start to look a bit slower than what we had seen them in the past.
All right. Vineet, just one more a point I wanted your thoughts on. I'm not sure if you wondered about this, but, for example, Whirlpool is looking to sell about 24% of stake in its Indian arm today, right? You've had so many other deals, Novartis, for example. There was Timken before that, et cetera, et cetera. And these are not investors where the lock-in is finishing and they're selling. These are parents who are actually monetizing their stake in Indian subsidiaries. I'm sure, when these blocks come, you would have been shown some of these deals and asked for interest. But what's going on? Is it foreign companies realizing that valuations are very rich and, make sense to monetize some of it, or is it something else?
So you're right, Prashant. I think not just the foreign companies, but we have also seen a slew of Indian promoters, encashing through the last 1.5 years as the markets are hitting highs. And maybe when we look at the valuations, most companies in their history, I think they are trading at the high point in terms of the valuation. So I think at this juncture, many promoters would like to encash. There are also other reasons, maybe the parent company globally are facing some stress. The balance sheets are leveraged, and they want to maybe moderate those things. So other aspects are also there, but most importantly, I think as we see that most of the companies are trading at peak valuations, these promoters are willing to encash, and that also to me is a hint that where there is a lot of frenzy. The retail guys are becoming really very bold in terms of buying stocks. It also at this point we should also try to caution some of the investors that stick to quality, stick to being more rational, and just try to take hints from these events, and then take a long-term view as far as the investments are concerned.
All right, we leave it at that. Thanks a lot for joining in. Appreciate your thoughts. So stick to quality and stick to growth. That's the word coming in from Vineet Samre. But for the market, it's very quiet, actually. To be honest, the Nifty is not doing much after yesterday's big run. It's just sort of holding on to that 22,000 mark. And there's quite a bit of traction on the downside in auto stocks this morning. So don't lose sight of that. But one space that has been doing pretty well is real estate. Brigade Enterprises is in focus. The company reported a decent Q3 numbers. The sales value gained by 56% year on year and the realization surged by 36%. The stock has gained 100% in the last 1 year. To discuss the demand trends, we have Pavitra Shankar, the MD of Brigade Enterprises, who joins us now. Pavitra, always great speaking to you on the channel, and thank you for taking the time out. I wanted to start by understanding what Q4 is looking like so far. What kind of traction are you seeing? And, what's the outlook on bookings by the end of FY24? Where do you think the company will be?
Hi, good morning. Thanks for having me. Traction is looking really great. We launched a large project at the end of last quarter, 2 million square feet that was doing really well. Actually, we launched almost 2.7 million square feet last year. We are on track to launch another 2.5 or so this quarter. And I think we are going to show some pretty good numbers by the end of this quarter. While we are not going to be able to give guidance, I think the trend on ground is very good demand from end users as well as investors in apartments as well as plotted projects across our target markets of Bangalore, Chennai and Hyderabad. So it makes us confident that we can continue to invest in land and look at new projects and continue to put our launches as quickly out there as possible. I think the market is looking very good for the short to medium term, and we should take as much advantage of it as possible right now.
Are you going to take advantage of the upbeat market with further increases in pricing or realization improvement? Your 9-month realization for residential is up 36% and is now close to 9,000 rupees per square feet. In FY25, for instance,
Yeah, so the realization is a combination of the projects that we've just launched. So the project that we launched last quarter was at a substantially higher price realization than some of the portfolio that was on that is currently being marketed. So therefore, it showed a higher realization. And every quarter that will be the case. So this quarter, as we're launching a plotted project, we may see a slight dip in those numbers. So it's very reflective overall of the quarter launches that have happened. But that said, if I look at a 9-month months comparison to the prior financial year, we still see a 20% increase. And I think that's reflective of the overall sentiment for the real estate segment. While Brigade per se has also increased pricing, I think it is reflective of the market as a whole in the residential sector. And I would say Bangalore is a huge part of that. Bangalore, up to a couple of years ago, I would say you could very easily find something between 6,000 to 6,500 rupees a foot, which in my mind was completely undervalued as a market. So given where the city stands in terms of an economy and an employment center. So I think there's a correction there for Bangalore that was long overdue. But in general, the residential market is extremely healthy and allowing us to take up pricing. That said, in future, I don't know if we can continue to expect, 20 to 30% increases. Those are pretty hefty.
Pavitra, hi, good morning. One of the things I've heard from sort of relatives and a lot of family in Bangalore is that the new houses have all become not Brigade, but otherwise generally houses have all become smaller, but the rates have all gone up. That's kind of a...
Actually, on average, I think houses have also gone up larger in terms of floor plans, and demand from customers tends to be looking for that extra bedroom, which is still, I think, the effect post-COVID. And even in our portfolio, we seem to be launching slightly larger units. So that's anecdotal, maybe. I think overall unit sizes are increasing.
I think that's the case not just with Bangalore, right? Throughout the country. That's a big problem we're facing in metros. But talking about metros, a lot of your peers have now entered the Mumbai market, and there's so much happening in Mumbai with the connectivity going up, with the Trans-Harbour Link, the Mumbai Metro, Coastal Road, etc. At any point, either in this financial year or next, would you look to enter Mumbai?
No, definitely not. Plan is to continue our focus on Bangalore, Chennai, and Hyderabad. I think over the last 2 years, we've added significantly to our Chennai land bank, and that's a market we feel very confident about, although we do feel it is overlooked by many in the segment. So I think Chennai is a stronghold for us. Hyderabad also is an area of focus. Our strategy is that these three markets can afford us as much growth as Bangalore. And that, is something that we want to focus on, not just from a residential perspective, but also office, retail, and hotel. Since we are a multi-domain company, the same investment that we make in land banks, in partnering with landowners, with licensing, and so on, it's important for us to make use of those networks that we're doing and go deeper into the markets rather than do multiple projects or maybe one-off projects across different markets. But that said, that's all naturally Mumbai, NCR, these are all very large markets. It's something we will always keep an eye on, but in the short to near term and actually medium term, our focus is to remain in the south.
What about hospitality? Despite Q3 being a seasonally strong quarter, a pickup in your occupancy to 73%, the top line growth has been in single digits, 8%. Going ahead, do you think hospitality, you could look at it, the hospitality segment could see a double-digit revenue growth?
Yeah, we are pushing on that front. I think it's always a balance of ARRs as well as occupancy. The hotel segment has done well. Hospitality, if I look at a year-over-year performance, it has done extremely well. So it could just be a bit of seasonality and specific reasons why. But we're very confident about the hotel segment as well. I think the amount of domestic travel that is really supporting all of our business hotels is excellent. We are also planning to invest further in the hotel sector. Currently we have just under 1,500 keys under operation, and we are looking to add another 1,000 keys to that over the next 18 to 24 months.
Okay, so you're adding another 1,000 keys to your hotel segment, and currently you have 1,500 keys under operation. Got that. Will there be any fresh investments that you're looking to make, any kind of debt that you'd want to take on for this kind of expansion that you're looking at, both in the hotel as well as in the residential space?
Yeah, so in the residential sector, so far, we've not really required to take on debt. Instead, we've been paying off the residential debt. Today, we're pretty much at a zero debt level for the residential sector. On the hotel sector and I guess office, like anytime you're investing into these longer term assets that have a longer life where you're leasing up and operating them, we are going to need to use debt for that. And we're comfortable at the debt levels that we are today. We will also use a mix of internal accruals from the cash that is getting thrown off from the residential sector. So as of today, today our debt equity ratio is 0.69, and we're quite comfortable at the level of debt that we have, also knowing that we will need to take on more debt to support the growth of the portfolio. But we have always done that in a fairly conservative way. Even our the interest rates that we pay have gone up naturally along with the repo rate, but have not grown as much as others have seen. So I think overall we have a pretty conservative approach towards debt, recognizing that you need it for growth, but also taking it in the right way.
All right, Pavitra, we'll leave it there. Great conversation as always, and good to hear you on CNBC-TV18. Thank you very much for joining us. Good luck. We'll take a very quick commercial break here. We are going to be joined by the CFO at 5-Star Business Finance to discuss their business outlook. Stay tuned. That conversation coming up next.
Welcome back. 5-Star Business Finance is the company on our radar. The company reported numbers on 1st of February on budget day, so we didn't get quite chatting with them. But just to recap the numbers, strong AUM growth, but the asset quality has deteriorated. The company's gross NPA stood at 1.4%, while the net NPA stood at 0.65%. Srikanth Gopalakrishnan, the CFO of the company, is now with us. Thank you very much for joining in. This is Rima here. So the first question is on asset quality. We have seen some pain at the lower end of the economy. What is your guidance and outlook on asset quality? Any numbers on the gross NPA and net NPA?
So very good morning to all the viewers, and thank you, Rima, for having me on the show. I would take a little bit of a disagreement with your statement that the asset quality has deteriorated, while the NPAs has shown a little bit of a spike, and this is largely to do with some floods that were there in Tamil Nadu, and more importantly, the coastal Andhra Pradesh also had an impact. So there were a little bit of impact on the incomes for a few days for the borrowers, due to which they were not able to pay a little bit of the EMIs that fell due during the month of December, which is why it just went up from 1.35 to 1.4%. But having said that, if you look at the numbers for the profile of borrowers that we are operating, I think we are still at a very, very attractive NPA ratios. If you compare it with any of our peers or even the large NBFCs, I think we stand out exceedingly well. What we also have done is we have increased the provision. So that's why if you look at the net NPA ratio, it has actually gone down from 0.68% to 0.65%. The guidance that we have typically been giving to the market is a steady state number of anywhere around 1.5% or thereabouts, which is still a very, very attractive ratio for this market, given the kind of yields that we're operating in and given the profitability that we have. Our ability to absorb this is very high. You should also look at this in context of the RBI circular that came in 2021, where today we are completely at par with NPA recognition in line with banks. So it's a daily tagging of NPAs, and once an NPA, it's an ever NPA till the loan completely gets off to a current stage. So it's probably the most stringent methodology to compute NPAs. But if you really look at 90 DPD, we will probably be 30 basis points lower than what you're looking at. It will be about 1.1, 1.15%. So from that perspective, these are attractive ratios, in our mind. A little bit of deterioration primarily because of few days of impact of floods.
Okay, that's a comprehensive explanation. Srikanth, hi, good morning. Prashant here. Now, your sort of customer base is essentially, small business loans, right? Shopkeepers, very small ticket size loans there. We've heard, from other companies, etc., we speak with, that there is a little bit of stress, and that's been true for a while, it's not new, that there's a little bit of stress at the lower end. The point is the market is so vast, the demand for credit is so large that you can pick and choose the good and avoid the bad, right? As you've told us in the past as well. But incrementally, is it going to start to add up a little bit? I mean, the environment is not getting easier in that sense, right? So, for example, I'll tell you, we had Amitabh Chaudhary of Axis Bank who was telling us, it was a broad statement he made. He said that in the next 6 months, you will see credit costs rise. It's impossible for them to stay this low. It's cyclical, nothing large, nothing alarming, but that's the direction. Would you agree in your context, Srikanth?
So, Prashant, like you said, I think it's a very broad statement that somebody has made. And the definition of credit or MSMEs in India that we use itself is a very, very broad term. And like you rightly put, we operate in the really lower end of the segment. We're probably a couple of notches above what a microfinance institution's clients are. So we lend between the 3 to 5 lakhs. And what we believe, and we have not been operating in this segment for the last 2 years or 5 years, we have been operating in this product and segment for the last about 20 plus years. What we believe this segment is all about is the resilience. While you will always see some bit of skews in their cash flows at points of time, these are people who are largely cut off from any kind of economic shocks, or even if there is an economic shock, they are probably the last to get impacted and the first to bounce back, primarily because of the fact that these people provide essential services to common man, without which people like you and me cannot be living. So we lend to shopkeepers, we lend to barbers, we lend to medical shops, we lend to hardware shops. So it's extremely essential for a common man to thrive. While there could be a little bit of skews here and there, we really don't see these customers defaulting. And more importantly for us, the way that I see it is these are all loans secured by the property of these borrowers. And this property represents their entire life savings. So it is not like for frivolous reasons, these borrowers are actually going to go and default the loan, or you will probably see intentional defaulters in this segment, because for a 3 lakh to 5 lakh loan, it's actually not worth committing a fraud. So our understanding of this segment very clearly shows that, like I said, we are going to be operating around, 1.5 to, there are about 10-15 basis points this way, that way of NPAs. But in context, what you should also look at is our DPDs across the various buckets has been getting better. Our 30 plus has actually dropped from 8.9% or 8.95% to 8.35%. So you're actually seeing, people getting a lot better in terms of their repayments. Our processes are also, we have fine-tuned a lot of process. Today, we actually measure the unique customer collections as against measuring the overall collection efficiency. So a lot of these things will actually end up having very good numbers. So, our credit costs again have been muted because we took a lot of credit costs, especially during the first and second waves of COVID. So if you look at our credit costs for this year, now the 9 months, I think we were at about close to 40 basis points or so. But again, we keep guiding the market that you should be a little more conservative, not because there is a stress that is getting built up, but it's also good to build up some provisions during good times that you can use during the rainy times. So, about 60-75 basis points of credit cost is something that, again, our P&L is extremely capable to absorb.
Okay.
But not
Can you give us
any,
Sure.
Can you give us any environmental stress?
Got it. Mr. Gopal Krishnan, can you give us some numbers on what one can look forward to in terms of both disbursement growth for this year and next?
See, this year on year, I think our disbursement growth has been at about close to 40% or so. We have done close to 3,500 crores of disbursements for this year. Again, Q3 has been almost flat to Q2 because, like I said, about 6-7 days of Q3 was lost to rains in Andhra Pradesh and southern Tamil Nadu. But we expect this number to pick up in Q4. So definitely, I think we will see at least about 25% growth in disbursals to come through next year, 25 to 30% growth to come through in disbursals. And again, we have also been guiding the market in terms of a 31 to 35% kind of a AUM growth that we are looking at. And both of these things at this point of time appear extremely achievable.
So, okay, so AUM in FY25 should be in the vicinity of about between 11 and 12,000 crores, sir?
No, Prashant. So we will probably end this year at about 9,500 to 9,600 crores. And if we're looking at least 32% growth from there, that's at least another...
Okay, 30% okay. 30% in FY 2025 over the 9,500 in FY 24.
Exactly. So we are probably looking at maybe 12,500 crores, 12,000 to 12,500 crores.
Okay. 12 to 12,500 crores in AUM. By the way, last time we spoke, you said that you had borrowed, cost of borrowing had gone up about 10 basis points. This was at the end of December. What have you seen so far in this quarter, Q4?
See, Q4 incremental cost went up by about 7 basis points. Our Q2 cost of incremental debt was 9.5. That went up to 9.57. Again, largely, I would say, primarily, because we are taking monies from some marquee names, we are getting quantums. So there's a little bit of premium that people are actually building up on that. But again, we are also guiding the market for a slight increase to come through. As you would be aware, there was a circular in November 2023 by RBI, where they have increased the risk weights. So that may have a little bit of an impact as we go forward. But our clear thought process is to get the right set of lenders to diversify our borrowings. And if that means there's going to be another 20-25 basis points of impact on cost, I think we are fine.
All right. Shrikant, we'll leave it there. Thank you very much for joining us. Appreciate you being here on this channel. And thank you very much for your time here today. Well, that's 5-Star Finance. Now, IRCTC is the next company. It reported a good set of third quarter numbers. Festive season in the third quarter aided business. And we saw, pretty much performance across the board coming in. Soft to okayish. We have Sanjay Kumar Jain, Chairman and Managing Director at IRCTC, joining in to take some questions. So thanks for joining us. Best ever numbers in the third quarter. Could you tell us so far? We're mid-quarter through in the fourth. Has the momentum continued?
This quarter has shown highest ever revenue and both profit also. In all our segment. So it's a good thing, and we are planning to continue it this year and take it to the next level.
Just wanted to get some numbers in on volumes. You did an overall volume of about 115 million in Q3. Is this the run rate likely going ahead?
Yeah, you see, numbers are just a projection, which may or may not come true. But I will just give you the brief of the background in which we are working. Like IRCTC is working in railway segment largely, and ticketing, what you are talking about, is basically railway ticketing. And you see the growth in railway sector, and Vande Bharat train already announced, 75-41 already running. So many such trains are going to come. So certainly it will add to my ticketing business, and not only ticketing business. This will provide us the catering business, rail near, and the tourism sector.
So from rail near particularly, what kind of revenues can you generate, and any further capex that you're planning to put in there?
Any business has some kind of capacity utilization, particularly when you are running a plant. So what we are doing at the moment, that we are adding to our capacity to fill the gap of the demand and supply. And I am happy to inform you that 2 days back only, we have added 75,000 bottles per day. And we are again going to add very soon another plant with 75,000 capacity, maybe by July end.
So you also have a tie-up with Zomato. So could you talk to us about the growth outlook in the catering business going forward? Last quarter, you did 500 crores there.
As you correctly told, that Zomato on e-catering side is already on our platform. And you see, again, I will tell you, you see the sector. Railway sector per se, economy is booming. Railway sector per se is also booming. Capex is invested. Many rolling stocks are coming. Many lines have come. DFC is also coming. So that will also release capacity for running passenger trains. These all things will lead us to how much we can grab is the real challenge. The growth per se is not, I'm not seeing any hindrance into that. Rather, it's very encouraging.
What's the outlook on the Bharat Gaurav trains? They've been performing well. So could you give us some color on the way forward?
You see, we have already entered into MOU with Uttarakhand government, and more states, we are already planning under the things is under discussion, which I can't reveal at the moment, but with other state governments also. So it's a very encouraging response. You see, we are already running 10+1 Bharat Gaurav trains, and there are many more in pipeline because of our MOU with the state government.
All right, one final question. By when will you target 5,000 crore rupees on the top line?
I told you that figures are only, projections are only figures. What we are targeting is not numbers. What we are targeting is the growth and how much we can grab the market already available with us. And for that, we are already putting our all efforts. And I see similar kind of, or rather better kind of result prospects in future. Thank you very much.
Okay, thanks very much for joining us with those details. Appreciate you joining us here on CNBC TV18. Well, that's IRCTC. The market, by the way, is come off a little bit more. We were down 50. There was a sharp recovery. We were down 20, and now we're down 70. So, the pressure is there, at least as far as the Nifty is concerned. Market breadth is also completely evened out. It was positive. Now it's, the advance decline ratio will tell you almost 1:1 on the advances to decline ratio at this point in time. So it's a mixed kind of two-way flow, as we were describing in the morning as well. And that's what we saw towards close. That's how we left off things yesterday in trade. Well, now sources tell CNBC TV18 that the Finance Ministry may hold meetings with Fintech startups next week. This move comes in after recent actions taken by the RBI against Paytm Payments Bank. Parishad has got more details. He's joining us right now. Parishad, good morning.
Well, yes, this is an important story for the fintech ecosystem in the country, and the importance of the meeting that is going to be held next week. The meeting will be chaired by the finance minister. Officials from other ministries are also likely to be present. The importance is twofold. One, to emphasize the importance of following all regulatory compliances. The government is likely to urge all fintech startups to make sure that they are complying with the law. Secondly, to assure them that if you are complying with the law, then there is nothing to be worried about. The government is fully backing you. This will be a meeting in a way to reassure the fintech startup ecosystem that this is a priority area for the government. The government stands by startups in the country. It wants more digitization to take place. And this is a sector that will continue to be encouraged by the government.
All right, Parikshit, thanks a lot for that. So fintech startups definitely in focus. But moving on, HDFC Bank aims to maintain financial stability and continue its trajectory of profitable growth, says the Managing Director and CEO, Sasidhar Jagdishan. Speaking at HDFC Bank's group event, he adds that the merger preponed the loan growth of the combined entity, triggering the need to raise funds. Take a look.
Ever since we announced the merger, we realized that with the merger will come a preponement of loans on our balance sheet, which is pretty much reflected in the constitution of the share. We now have around 14 to 15% share of loans on the stock of our balance sheet, as against to 10 to 11% of deposits. We realize that effectively we have preponed the loan growth, so I need to now have that period of I would say, transition time to warm up the engine to raise that amount of equivalent granular, sustainable funding to be able to substitute some of the bond maturities so that I can have a reasonable amount of share moving up. We have been operating our loan deposit ratio in a reasonably healthy range of around 85 to 90% or 80 to 90% depending on which year it is, and it's a long-term average. Obviously, we have grown, which means that the growth rate in our deposits and loans have been rather on very similar pace of growth. Going forward, whatever we do will be very similar to what we have done in the past, which means that we'll maintain a very healthy incremental LDRs. As I said, it's a balance of how much I want to deploy and how much I want to repay, and that itself, since these are all high costs, it sort of gives you a kind of a massive fillip to your profitability.
All right. Well, let's do one thing. Let's take a quick commercial break on that note. The Vibhor Steel Tubes, by the way, has listed, look at that. It's a 190% up move that we're seeing on listing for Vibhor Steel Tubes. What a fabulous listing there. I don't think anyone expected such a big premium to the issue price. 150 was the issue price, and look at that, 446 is where the listing has come through.
The bankers get it wrong. I'm not sure the bankers left it intentionally. I mean, this much, I mean, this is incredible. One of the best listings that we've seen, I think, in the recent past. Absolutely, no doubt. Look at the volumes, about 1.3 million shares, I mean, traded already, right at listing.
I think this space is doing very well, right? Its peers are APL Apollo Tubes, you have Rama Steel Tubes, High-Tech Pipes, APL Apollo Tubes, etc. have been big movers in the recent past. Even if you look at the fundamentals, right? I mean, 3 years back, the company's revenues were about 500 crores. Today in FY23, at the end of FY23, the revenues were 1113 crores. And 6 months FY24 as well, the strength continues. And the profitability. The FY21 profits were about 60 lakhs. And by the end of FY23, they're sitting at 20 crores of profit. So fundamentally as well, the company is strong. It's in a good space. And hence, it's delivered on listing day. Let's slip into a quick break. On the other side, Manisha Gupta will put focus on the commodity markets.
All right, 60 points lower on the Nifty is what we have, 22,063. So this is a bit of a breather coming through this morning. Prakash Gaba is with us. Prakash, good morning. Good to have you with us here. You know, dips typically, I mean, yesterday also we saw that dip, right? The market opened higher, flatlined, and then moved up. And then, of course, from the day's high, there was a bit of a pullback again. But what's your sense, Prakash? What to do on the indices first?
Yeah. As far as Nifty is concerned, it's open lower, it went down lower, and it bounced back. So far, looks okay to me as long as today's open holds. And Nifty has opened somewhere closer to 46,600. So as long as that's on, it can go into a resistance zone. The resistance zone on Nifty, I would say that possibly it's around 22,150 or so. So it can go up. Bank Nifty looks, I think, slightly more stronger, can go up to 46,700 to 47,200. But Nifty and Bank Nifty both are on divergent mode. So had the Bank Nifty fallen, then Nifty would have fallen more. But looks like Bank Nifty could hold because the Bank Nifty still looks strong to me. So I would say Steve is stock specific and try and take stocks on the long side on the banking front. And however, I like two stocks here. One is Indian Hotels. That looks good to me. Very good chance trading at 550. Possibly we can see move up to 560, 65 zones. Stop below 545 on Indian Hotels should be fine. Second stock that looks good to me is Power Grid. Basically into a buy mode. 285 is the level that it's trading now. Possibly we'll see level closer to 295. May take a day or two for that. I think it's heading there. Stop on Power Grid should be around 280.
Okay, all right. Thanks a lot for that, Prakash. Have a good day. By the way, those are some stock ideas from Prakash Gaba. Just want to point out once again, Vibhor Steel, right? Pull it up for you. It's had a fabulous listing in case you missed that one. And the joke doing the rounds is, iska naam Vibhor Gold hona chahiye tha, not Vibhor Steel. That's the, that's the up move that we're seeing in fabulous listing there.
I mean, look at that. What, 450 now, right? So that is it's I think the listing of the year so far. I think without a doubt. And if you go back, you'd find comparables, but this is absolutely fantastic coming through. Well, let's sort of talk about commodities now, and let's bring in Manisha with what's top of mind for her. Manisha, good morning.
Morning, and thank you for that, Prashant. Well, I'm looking at the crude oil prices, which are trading at a 3-week highs right now. If you look at the prices within this year, we've gained up by nearly 6% already. And there has been a lot of geopolitical premium that we've seen building up in case of prices here. In the latest report that the street is watching out for, well, there is Israel raiding Gaza Strip. The second hospital is out of service now. There also is Houthi fighters claiming responsibility for an oil tanker which was headed in for India. Over the weekend, we already have seen reports of 4 vessels hit by drones or missiles within the Red Sea itself. And this is what has added premium to prices. Apart from that, the street is also looking at strong travel numbers that have come in out of China in the previous week. Remember, it was the Golden Week holiday for China, and those travel and aviation and on-road numbers, all of them have been on the positive side. But that's exactly where the positive news kind of ends. And these are the factors keeping the prices in check. There is a report from IEA suggesting that the global supply will hit a record 103.8 million barrels per day in 2024. And much of this extra supply growth will come in from the non-OPEC countries. Within OPEC as well, when you look at the spare capacity, which is at an 8-year highs of 6.4 million barrels per day. So if and when that demand comes back, you already have higher inventories, higher production. US production is at an all-time high, and the OPEC spare capacity at an 8-year highs as well. So there is a very little chance that you could be looking at 90, 95 or prices beyond that in the near term at least. An ANZ report that came in last evening suggests that global crude surplus is what they are looking at in 2024. And then apart from that, we already are dealing with those slowdown reports that have been coming in from Japan and Britain. So the demand, in addition to China, within these economies as well seem to be slowing down. Another interesting report that I want to put on screen is from Morningstar, which says that the global demand will drop to 88 million barrels per day by 2050 from 99 million barrels in 2019. While there are various reports coming in, but just imagine that from 20 years down the line from here as well, it's not that the global demand for crude is going off too much. It still is expected to stay around that 88 to 90 million barrel per day, and that is in 2050. And that's something in sense of long terms. If there are no investments that are coming in, the street does believe that $80 or about is where you could be looking at the crude oil prices sustaining for a slightly longer term as well. And this is even taking in account that by 2050, 57% of all vehicles would be EV there. So the markets do believe that it is going to be for this quarter around 80 that you could be looking at the crude oil prices sustaining within. And for this year, the range clearly is between 78 to 88 as of now.
Right, Manisha, thanks very much. Interesting numbers, interesting stats there. Thanks very much. Well, the Nifty, by the way, is sharply recovered. There's a very sharp spike which is sort of developing, and it is underway right now. So we were at 22,070 and we're at 22,095. So 25 points pop up coming through on the index in the last under 5 minutes or so. But we continue to track markets for you, but we'll take a quick commercial break here. On the other side, our special segment, Indianomics. My colleague Lata will connect with Samir Goyal of Deutsche Bank to decode key trends in Indian bond yields, the US inflation data, both on the consumer side and the producer side, which came in last week. Stay tuned.
Welcome back to Indianomics. Indian bond yields fell dramatically after the budget, but most of those gains, which were caused by the lower market borrowing program, were wiped out because of the higher than expected US yields due to higher inflation in the US. So how will Indian yields shape up in the coming months? Separately, the Indian rupee has been solidly ranged despite rising US yields and the occasional rise in equity outflows from India. Will the rupee appreciate this year thanks to bond index inclusion inflows? For all these questions, I'm joined by Samir Goyal, Global Head of EM and APAC Research at Deutsche Bank. Samir, good morning and thank you very much indeed for joining us.
Morning, Lata.
Well, the first thing that's shocked the market lately has been the US PPI numbers, and before that, the US CPI numbers. What's the expectation now? What is the rate cut pushed out to? And more importantly, what's your view on the US 10-year yield?
So, Lata, obviously the inflation numbers last week in the US, both the consumer price and the producer price numbers were higher than expected. And I think not just about, it's just not about the numbers being higher. I think they very seriously call into question the idea whether we have seen the best part of the disinflation process already over with the US, and whether, and similar to the concerns with a lot of the Fed speakers have been voicing, is it that there is a big last mile issue on inflation in the US, and how quickly they can get confident about being able to get to their target sustainably for inflation at around 2%. Now, I think in terms of numbers, what these prints from last week do is only marginally impacted our own forecast for core PCE in the US, probably being still at moving down to about 2.3% by the end of this year, and which should be largely in line with allowing the Fed to be able to start to cut rates by the middle of the year. But it does raise issues about whether and how quickly and how closely we need to watch the inflation trajectory in the US to be able to get the timing and the scale, the quantum of that easing through. The markets have already pulled back on their expectations of the Fed cuts pretty substantially. At the start of this year, we were pricing in close to about 150, 160 basis points of cuts for 24. We are now pricing in less than 90 basis points. So I think the market narrative has very clearly moved closer to the Fed in terms of its concerns about how sustainable this path of disinflation here is.
Okay, but for us in India, the more important point is the shadows cast by the 10-year bond yield on Indian bond yields. Now, what is your estimate? There is also this fiscal angle. Being an election year, we could see a repeat of the first quarter, you know, the October, November, December fiscal deficit getting extrapolated, in which case the US fiscal deficit could even go to 8%. So do you think, therefore, that the bond yield doesn't fall much, the 10-year Treasury yield? What's the range you're looking at?
Yeah, so I think the Treasury yields do feel like they are fairly well supported here, and especially sort of north of 4%. I think there are several dynamics, of course, which go into Treasury yields. It's not just about the Fed view, it's also about the quarterly refunding announcements which have come out, which seem like the worst of the duration supply is kind of past us, but obviously concerns around elections and about what that could potentially mean for fiscal policy, though a lot of that is, I guess, more of 25 rather than an issue for 24 immediately. The Fed's also been expressing concerns around quantitative tightening and as to whether they will necessarily continue with that same pace. I think a lot of these dynamics come together to our mind to suggest that you will see a bit of a support here as far as Treasury yields are concerned. We still think the curve will bull steepen. Right now, you're seeing the 2-year, 10-year spread at being close to about minus 40. We think by the end of this year, we flip to about plus 40 basis points, but that's largely as the front-end yields come down. I think the back-end yields we feel around in the 420-25 region seem fairly well supported. There is even a risk that if the current sort of trend of good data continues in the US, that we actually see the yields move up a little bit further before, to our mind, settling by the end of the year at around this 415, 420 levels.
Oh, really? You expect it to go even higher. In that case, where does that leave, say, Indian bond yields? Your own report, I think my chat with you earlier, you had suggested that yields could come down because of the bond index inclusion. The Indian borrowing program is also lower than what the market was estimating. So what are your yield expectations on the Indian 10-year? And will that be spoilt by the US yields remaining very high?
So I think the US yields are a factor to the extent of determining, if you might, the timing of how quickly the yields can reprice, not just in India, but most of emerging markets. But I think ultimately the direction of travel is very clear. I think in the case of India in particular, we've always thought that the beta to US yields is relatively low compared with a lot of other emerging markets. India as an economy has proven to be a lot more insular to the volatility in the global economic and rate cycle. Like you said, the longer term narrative around bond index inclusion, the fact that we are well on the path for fiscal consolidation, and that's largely meant that the bond demand-supply dynamics has become a lot more favorable towards for India into FY25. Obviously, our outlook on RBI, we still think the Reserve Bank will be in a place to potentially change its stance by April and maybe start cutting rates by June. We still think we'll probably get about 100 basis points of rate cuts in fiscal 25. I think a lot of that comes together for us to remain relatively fairly constructive on Indian bond yields. Our targets being, at least the first initial targets being to get to about 675. I think, again, the timing of that could be a little bit more predicated on when we actually see the rate cuts, when we see the flows relating to the index inclusion. But to us, there is still a good case to be long Indian fixed income.
That will be something of a historical new. The US yields being, the Indian yields being only about 200 basis points higher than the US. I mean, if what you say is 4.5 or 4.25 for US 10-year treasuries, then Indian 10-year at 6.75, it's kind of a historical low, right?
I think it's a structural re-rating. I mean, a little bit of this is about a bit of a mistiming in business cycle, where you're clearly seeing the US rate cycle being if you might, pushed out because of the path of disinflation. And like I said, the last mile problem, which India doesn't necessarily have. We think core inflation is going to average at 4%, maybe even slightly below in the next fiscal year. We think headline inflation is going to come in closer to RBI's target of 4.5%, or what's projecting 4.5% for the next fiscal year, gives RBI that space. So some bit of this is about a business cycle and policy cycle mismatch. Some bit of this is also about a structural re-rating, where the Indian economy, with its much better growth and inflation mix, and how that allows the risk premium built into the curves to be structurally lower, and should be able to bring the rate differential between US and India narrower than what it has necessarily been in the past.
Okay. What's your estimate of the amount of flows that Indian bonds can receive because of index inclusion? There is talk that the Bloomberg Barclays index will also include India soon. So what's the kitty you are looking at?
So, Lata, I think the math on that is relatively straightforward. I think for now we know that the GBI will include India, which should be roughly worth about $20 billion, $25 billion or so of inflows which are to come in. They will be staggered just as the inclusion for the market into the indexes, but ultimately the weight is capped at 10% in GBI. Like you said, the next thing to look for is at what point India gets included in the Bloomberg Barclays Global Aggregate Index. Now that has its own hurdles in terms of what the index participants require and are looking for India to get included. It's a global bond index. It's got much larger AUM, which is tracking it. It's got much larger market capitalization. India, if it does enter that index, will have a relatively smaller weight compared to the GBI, but potentially much larger flows, because there's a much larger amount of global money which tracks that index. I think a lot of that could probably be towards the end of this year, or only maybe a 2025 issue. But overall, we are at least looking at $25-30 billion potentially in the next fiscal year.
Okay. In that case, where does this leave the rupee? The Reserve Bank has held it in such a tight range, 83 to 83.3 is all that it has moved despite all these vicissitudes. Now will it rise? And the other point that some market guys point out is that the Reserve Bank also has one eye on the CNY rupee exchange rate. So can you also tell me whether the CNY will be allowed to depreciate simply because it looks like China wants to look at the export way out of its current slowdown?
So Lata, I think the way I look at the rupee, there is, and as you have also actually enunciated, I think there is multiple cross currents here. For the rupee. I think on the one hand, one very critical factor will be whether we actually see a more pronounced dollar down cycle happening, which at the moment seems very constrained by the fact the US as an economy is clearly outperforming the rest of at least the developed world. I do think versus emerging market currencies, the dollar will be more influenced by growth considerations than rate cycle considerations. But nonetheless, the dollar seems on, at least for now, a relatively strong footing. For India itself, the currency is not necessarily cheap when you compare it to inflation differentials with India's trading partners or on basic balance front. But on the other hand, we do have potentially better flows coming up ahead, both in terms of whether they do into equity markets at or following the elections, and certainly into fixed income because of the index inclusion issues. I think ultimately the deciding factor would be whether policy permits those flows to come into the market or intermediate it, as to whether is keen on keeping volatility very low or allowing that to translate into better appreciation and gains for the currency. I'm personally biased myself to think that the currency will probably towards the latter part of the year be somewhat stronger than where we are, but I think still very much contained within a range.
No, I must get your view on China. Do you expect that because of this, manufacture your way out of the current problem, China is actually capturing global market shares, even in cars, EVs, lithium batteries, and they're cutting prices. They're seen as a deflationary force. Where is the CNY expected to go? Will it depreciate? And if it depreciates, is there a chance the rupee may depreciate rather than appreciate?
So I think on the renminbi, Lata, one point I would make is, I think what is often misunderstood is that while there is clearly benefits to a weaker currency, especially to one which is quite as much of a manufacturing sector as China is, there are definitely benefits to a weaker currency in terms of gaining more competitiveness, but there are also costs to a weaker currency, and particularly in terms of engendering an expectation cycle, which can actually cause the depreciation to build on itself. And to that extent, for policymakers, there is a very clear cost-benefit analysis there. And they have thus far responded to what has been relatively negative news on the China economy, on the China business cycle, by leaning back against, pushing back against any of that weakness in the currency. I think ultimately it's a policy choice to make for them, but it's not clear to me that from simply the benefits of gaining more competitiveness necessarily outweigh the cost to them of allowing sharp depreciation in the currency. To take place. So you're right that for the rupee, the renminbi will be an important factor, but I think the cross is no longer at a level which creates a huge amount of concern for the Reserve Bank.
Okay, you don't have a CNY level for range for the year?
So our view is that if anything, if we see a positive momentum build up as you get a positive policy stimulus in China, there is very much a risk that the renminbi actually appreciates up towards 7. So not a very large amount, but a modest appreciation, but very predicated on whether we see the kind of policy stimulus which is required for growth to outperform China in China at around that 5% level.
Thank you very much for joining us, Samir Goyal. So the key takeaways, Indian yields are about to fall to about 6.75, but the rupee may be more ranged and maybe appreciate just a wee bit. That's it on this edition of Indianomics. Thanks much for watching.